Today we'll finish up the homeowners insurance policy, and then we'll cover a few minor policies: flood insurance, the FAIR plan, personal umbrella. Talk about those, and then we'll start getting into the mold issue in Texas. Although it's not a huge issue today in Texas or really in any state, it sets up some really interesting, I think, really interesting issues for insurance companies, for actuaries, for pricing. And then that'll set up what I want you to do is watch a video, and I'll get into that video where the mold issue in Texas really got its media attention with this one particular case. So last class we were finishing up homeowners, and we got to these endorsements that you can get, this extra coverage you can get over and above what a standard policy would get. And the first one is the personal articles floater. This is for people who have special items. Maybe they're expensive or they're hard to insure, where you can insure them but you specifically list them. So you have these essentially scheduled personal property valuables that are susceptible to loss or difficult to value. So it provides all risk coverage with no deductible at the policy limit. It excludes, since it's all risk, remember all risk covers everything except for what's excluded, so it covers everything except for wear and tear, insects, and war and nuclear hazard. You notice war and nuclear is an exception for a lot of policies. You set the policy limit separately, and you might do it item by item, or you sit down. You probably have noticed this with PBS has the roadshow, antique roadshow, where they say I recommend you insure it for X dollars. So it's essentially, the more you insure it for, the more expensive it will be, but at least it gives you a sense that if something happened, what you would get. If it's scheduled, it's not covered by your homeowner's policy because now it's part of your personal articles floater. It's covered anywhere in the world, with the exception the fine art is only covered in US and Canada for some reason. If you're insured, it pays the less of the actual cash value, cost to repair, cost to replace, and the policy limit. For fine art, coverage is a lot like life insurance. Fine art is one of those exceptions where we talk about property and casualty insurance being an indemnification type of coverage, which means its goal is to bring you back to where you were before. So if your house burned down, it builds you a new house. If your car was damaged, it gets you a replacement car. Fine art, you really can't do that because fine art is unique. There is no other fine art that's exactly like what you might lose. And in that case, you set the value and it will pay the amount shown in the policy. Now, I haven't researched this for cases. Maybe this could be a paper too. I don't know. It might be a little too specific, but you can just see that this type of coverage sets up a moral hazard where people might insure it for more than it's really worth, and then it gets lost and they get it replaced just to get the insurance money. So there's got to be some case history in the past where people have insured for an amount in order to get the insurance and then set up a loss to get that insurance. Now, it's probably happened with fine art or something else where it's just the value is very high, it's very subjective, and the insurance causes people to actually generate a loss on purpose. Personal property replacement cost endorsement is interesting, is when if you don't want actual cash value, you want to actually get a replacement. So if you think, okay, I don't want to get what this thing costs minus depreciation, I just want to replace it. And this is for these personal items. It's not for the house. Remember, the home is already replacement costs because you can't replace a 20-year-old home with a 20-year-old home like you can with a car or with a TV or other things. But if on those things that are actual cash value, if you want to get replacement costs, you can do that. You have to be careful that you have the right limits to be able to cover that, because you never get more than your limits. It's interesting, Liberty, I've noticed Liberty Mutual Insurance Company talks about replacement cost endorsement for auto insurance, and that just seems really bizarre to me, because it again sets up a morale hazard that if you have a 10-year-old car and it's going to be replaced by a new car. I was trying to read the fine print on Liberty Mutual. It would be interesting if anyone wants to look into that, or if anyone has that, bring it up in the class. I'd be really interested to see. That seems like that would increase the costs dramatically. I do know there's insurance that is specifically for cars and when I was on a credit union board, we sold this insurance. I thought it was horrible insurance, but people were buying it. But it's the issue of you buy a $40,000 car, and then your insurance gives you actual cash value, but because people are getting these 6-year loans, the cash value could be much less than what the loan amount is. And so they have these policies that actually this insurance, and it's not always sold by insurance companies or directly, it's many times sold by banks or in credit unions, that it gives you enough insurance not just to get you cash value, but to pay off whatever the loan balance is. So this one's somewhat similar to that replacement cost endorsement. If you really do not want to get a 10-year-old, 5-year-old item replaced, you can buy that protection. Inflation guard endorsement, that we talked about that for replacement costs, to make sure that the replacement cost keeps up with inflation. Earthquake endorsement, we talked about that. Earthquake is not covered by homeowners insurance. So in California, you have to get an earthquake endorsement. It covers all earthquakes within a 24-hour period as one single event, because with earthquakes you get tremors after the fact. Flood or tidal wave losses are not covered, even if directly related to earthquakes. So flood is always covered by flood. We're going to talk about that. It's one of the issues we are going to relate to the mold issue in Texas, is try to tie that to the storm surge issue with hurricanes. The deductible here is probably incorrect. I know in California the earthquake deductibles have gotten really, really high. 5% is a really high deductible. There are people in California with deductibles of $10,000, $20,000 just because earthquake is a really tough coverage for insurance companies to cover. It falls into that category we talked about, where it may be low frequency, but the severity is so high because so many houses can be impacted at one time. That's what we're going to talk about, that same issue with flood. So earthquake might be in that issue. Hurricane might be that issue of far too many people can be impacted all at once. So it makes it very, very dangerous for insurance companies to insure it. And we saw that in your paper one with what Warren Buffett was saying. You don't want to insure losses where they can aggregate and you can lose a whole lot of money all at once. So that brings us to the flood insurance. Flood insurance is not covered by homeowners insurance. And the reason for that is because of that issue Warren Buffett talked about, the aggregation of losses. A major flood can cause so much damage to so many houses all at once that insurance companies just could not insure it. It was just too large of a risk. And so they stopped insuring it, and the federal government took it over. In 1968, they had the National Flood Insurance Program. It's managed by the Federal Insurance Administration under FEMA. You probably have heard of FEMA, Federal Emergency Management Agency. They got a lot of press during Hurricane Katrina, a lot of bad press. FIA is like an insurance company. They determine the rates, the coverage, the eligibility. The insurance companies will actually sell these policies under their own names, what they call write your own program, but the insurance companies are not insuring these. I remember at UTSA, at the end of the year, we would figure out what our bonus was going to be the next year, and we were all hoping for no hurricanes. or no major catastrophes. And I remember people telling me there was be a major flood event, and people say, "Oh, there goes your bonus at USA." And no, flood was not an issue. Flood didn't harm us. It didn't hurt our financials at all. USA really had no exposure to flood whatsoever. So if the claims are greater than the premium, then the NFIP reimburses the insurance company. It's a stop-loss type of program. If the premiums are greater than the claims, then the insurer pays the difference to NFIP, although the insurer gets a small commission. And most of these policies are issued through insurance companies. And the insurance companies are very strict. I remember at USAA, the flood program there, they kept everything in a separate bank account, and they did not let anything commingle with that. They were very, very strict. Keep that program exactly, very well documented. No commingling of monies. Its own separate bank account. So when claims were paid exactly out of that account. So you know exactly what that program had in it and going in and out. So very, very important program for insurance companies because they do want their customers to get flood. Insurance companies don't really make much money off of this program, but it does help them give peace of mind to their customers. So they like being able to offer it, and they will help their customers understand whether or not they need flood insurance. So how does the NFIPs, how does this program work? How do we as taxpayers, how are we protected so that we don't pay out a lot of extra money to protect flood where people that are buying insurance will be paying for it? So the FIA will go around and look at communities, and they will determine if a neighborhood or an area is flood prone. And if they're flood prone, then they go into a special program at the federal flood program, and the community can protest their designation that they're in a flood prone area, or they just not participate, or not participate in the program. But it's a way for FEMA to encourage neighborhoods to do flood planning, to put up protection, to build waterways, to conduct flood waters to certain areas. So it's really a way to encourage good risk controls and risk management. So they have two programs then. They have the emergency program and the regular program. The emergency program is for those flood-prone areas. They receive insurance at subsidized rates. They have maximum limits that are much lower. They can't obtain federal and federally insured money for new construction unless the flood insurance is purchased. So again, it's their goal is to let these communities know that, hey, you've got risk, high risk, accelerated risk, exaggerated risk for flood. These are the things you need to do so you can get into the regular program. The regular program is dependent on the communities enacting these flood plan management regulations. If they fail to convert, they're not eligible for flood insurance, or they get higher limits. The program does not cover what is covered by the homeowner's policy and has the normal exclusions. So there's no duplicate coverage here, and it does have the normal exclusions. I don't know if a flood would be caused by a war or a nuclear event or whatever, but it does have those normal exclusions. It does get replacement cost coverage. The challenge is the limits, and we'll talk about this as well when we talk about storm surge. The limits are often way too low for some of these very expensive homes on the coast. And so when we look at hurricane, this is going to be important when we talk about storm surge. Storm surge is all that water that the hurricane brings in. So homeowners insurance covers hurricane damage, but does not cover storm surge, does not cover all the flooding that the hurricane brought in. And so when a hurricane destroys a house, the insurance company has to decide how much of the damage was due to the wind, the hurricane, and how much damage was due to the storm surge, all that water that came later. And the two are separated. And so you could have limits on your house of $700,000 because of a very expensive house, But if the federal flood program only provides $200,000 of coverage, the part of the damage that is due to flood will be limited to that limit at the percentage of that limit. So limits are an issue. That's one of the reasons I really don't understand why people buy expensive houses on the coast, because flood is a huge issue for them and they really cannot get adequate coverage even with this program. The Fair Access Program, we'll talk about this more when we talk about auto insurance, but it's a federal program which is trying to protect certain areas that have a difficult time getting insurance. You can see it also was passed in 1968. So for areas that are underserved by the voluntary market, especially metropolitan areas, the federal government steps in and requires insurance companies to offer this. They essentially divvy these policies out to all insurance companies. So if a property owner can show that they are unable to obtain basic property insurance from the private market, from the voluntary market, they can apply to a state's fair program through an agent or broker. The insurance companies provide policy over service and claims administration. I don't know why there's a comma there. Insurers get a percentage of the premiums for providing these services. All insurers participate in the losses proportioned to their share. So these programs generally lose money because the reason people cannot get insurance is because there really is higher frequency, higher severity. And when the state steps in and assigns this, they do it at subsidized rates. And because of that, they cannot, there's no way to make money for the insurance company. It's a much bigger issue on the auto side, so we'll see this on the auto side where we have these assigned risk pools that states create. I think it's a much more serious issue on the auto side. On the homeowner side, I somewhat understand there's someone living in a neighborhood that's considered dangerous, and the state wants to say, hey, they need insurance, but they can't get it. On the auto side, essentially what the states are saying is, hey, we have these dangerous drivers. They cause a lot of accidents, and because of that, they're having a tough time getting insurance. So we're going to help them out and make sure they can get insurance. That seems bizarre to me to do, but that's the nature of these programs. Many states have a special issue either with earthquake or hurricanes, so they have special programs. Florida and Texas have special wind pool plans. California obviously has an earthquake coverage plan. I think Hawaii has their own windstorm plan. These are state-provided programs where the policyholders buy through the state program, and they have their own funding, and they pay they're just like insurance companies. And when they run out of money, if there's a major disaster, then the taxpayers essentially step in and take over the payment of these. The one in Texas is called TWIA. So it's the Texas Windstorm Insurance Association. Here's their website. And they look just like an insurance company. You can see they requested a rate increase. That's kind of interesting there. They had a rate increase, and it was rejected by the Texas Department of Insurance. What this is, because the state actually runs this, is the state legislature has a setup, all the rules for this, including what happens if there's not enough money. What Texas essentially did there for several years, this TWIA was materially underfunded. If there had been a major hurricane, the Texas taxpayers would have had a huge multi-billion-dollar bill to have to pay. And what the Texas legislators essentially decided to do was hope for or plan for no major hurricanes for several years. That was really the only way this plan was going to work out. Let it build up premiums over time and hope for no major hurricanes. And they made it for several years. Then Harvey hit Houston, and I don't know what Harvey did to TWIA. If you're interested, TWIA could be a good discussion for paper 2, looking at the history of TWIA and then looking at how TWIA was impacted by Harvey and some of the other major hurricanes we've had in Texas. It would be interesting. You can see their website has some good analysis. You can see what parts of Texas are covered by it. There's 185,000 policies. They have funded. They have funding of $4.2 billion. So it's an interesting plan. You could probably do some research on how it works as an insurance company, what the insurance industry thinks of it. So try to get some sense of the insurance industry's view of it. But there might be enough there for a paper. I'm not really sure. You can see they have extra things on their website that you could research in. That would be, I think, interesting to look into. The other thing you could add to this is there's another organization, the Insurance Council of Texas. The Insurance Council of Texas, ICT, they're the ones that provide the scholarship in the spring that I will be recommending you apply for. They would have a lot of resources on TWIA, so you could probably, I don't know, I've never tried this before, but you probably could do a search on TWIA. So you can see a lot of things come up with TWIA as well. And you can see there's a lot written there. So TWIA can be a topic, and ICT can be a source for your paper 2 topic, not just for TWIA, but for several things. So the ICT is a business organization. They have membership from all the major insurance companies in Texas, and they do a lot of good research. They have some really interesting, excellent videos that they have done on hurricane risk in Texas. And there's one they did just a few years ago that I thought was really quite excellent. So, and that's probably on their site somewhere. And they do help college students get jobs in the insurance industry. So I'll be showing you some of their resources that can be quite helpful. They actually have in the summer a forum where they let college students come in and interview with companies, and I'll let y'all know about that later in the semester. I'm not sure how COVID-19 has impacted what will happen in July. They usually have their forum in July, but I know last year it was somewhat disrupted by COVID-19. Then the next section is umbrella. I put umbrella here under the homeowners. It could have gone under the auto as well, but it's personal liability insurance. So you might say, why do I need personal liability insurance? Don't I have liability under my homeowners and under my auto? And you do, that's true. And those are really good coverages, especially your homeowners really does provide significant liability coverage for a lot of things. And then your auto provides you specific liability coverage for when you're driving. But what personal umbrella does is it provides a broader category of liability protection, even over above what homeowners and autos covers. But it also gives you higher coverage, higher limits, because homeowners and auto there's going to be a limit. It's hard to get more than, say, a few $100,000 on your auto and home. So umbrella, and I have an umbrella policy because I worry about liability risk, especially with driving. If I did, I remember once when I was in Houston, I wasn't paying close enough attention. I pull out of a fast food restaurant. There were no signs on the streets, so I think part of it was the city of Houston's fault. But it was a one-way street, so I'm turning right into traffic, and I was very lucky I didn't run in. Can you imagine? There's just a school bus coming by, and I pull right out in front of it. The liability risk, first you just feel terrible that you've caused all this damage and harmed people, but also the liability risk could have been huge. I probably would have gotten killed in that case more than the school kids. But you think about, driving, it's really dangerous. And if you have a net worth that's higher than what your auto policy covers, then you have exposure there. And the auto policy is not set up to provide this mega massive liability coverage. So umbrella is set up to give you excess loss. It gives you coverage over the limits that you have in your home and auto. So it's essentially catastrophe coverage. It does cover other things that homeowners doesn't cover, something like slander. Most policies technically require that you have at least $100,000 of homeowners and $300,000 of auto insurance liability coverage. Now, if you don't have those, it doesn't necessarily mean that your umbrella coverage is void, but what it does mean is that your deductible now becomes $100,000 and $300,000 depending on the nature of the liability. So if you don't have the underlying, the umbrella only covers you once you hit that underlying. The policy limits can go up to $5 million, probably higher than that. So how much do you need? You need to cover your net worth is what people say. One thing we'll talk about here later when we talk about especially some of the commercial liability risk, medical malpractice and those things, especially medical malpractice, is why don't people sue you for your net worth plus the insurance you have? And I had this conversation with my insurance company is, okay, here's my net worth. And I say, well, that, if you know, that's what the umbrella needs to be. It needs to cover that. And I say, well, but if they know I have this much in coverage and they know my net worth is that, let me do some extreme number. Let's say someone has $50 million of net worth and they buy $50 million of coverage. Why wouldn't someone just sue them for $100 million? And in which case, you can never have enough insurance. You'd have to get $1 trillion in insurance. And then they'll sue you for $1,050 million. You know, so, and they couldn't give me an answer on that. I think the courts generally, and we'll see this with some of the tort reform, is to say that you cannot take in consideration the insurance someone has when you sue them. So you can't sue for the insurance plus the net worth of the person, but those are debates that each state's having, and so it's a little tricky to know how much to buy. So essentially what you do is, if your net worth's not that high, you don't have to worry that much about it because they're not going to sue you anyway. So the typical that you get for homeowners and auto is enough. If your net worth is high, then you just get a high amount, and you just hope that that's going to cover whatever damage you could do. It's hard to do much more than $5 million in damage, but if I were to turn my car and hit and go fast, or maybe the school bus is traveling at a high rate and runs into me because I'm not paying attention, I pull out in front of it and cause major damage to 50 kids on the bus, that could add up to $5 million pretty quickly. You know, each family is going to sue me for $1 million. You know, that could add up pretty quickly. So we can, when we're driving our cars, we can really do tremendous damage. It's pretty rare. It's not something that happens all the time, but it's certainly possible. Much more on auto than it is on the homeowner side. It's hard to think of a homeowner side. I do live in a condo, and so I think if I were negligent and left the stove on and then went on a 2-week vacation and ended up burning down the entire condo, could that add up to $5 million or more? Yeah, possibly. Certainly, if there's loss of life, there could be. So it's possible. So this is something it's hard to really, as your wealth gets higher, and you're all going to be wealthy people with your degree from UTSA and your just the nature of the kind of degree that you're seeking. This will become an issue for you probably as you get into your 40s and 50s and thinking about how much coverage you need. So don't forget about this. As your net worth gets up into 7 digits, you need to start thinking about extra coverage. One reason I say that you should think about this coverage is that it is amazingly inexpensive. This is not anywhere in the ballpark of what your auto and homeowners insurance costs. Sometimes, I mean, maybe $50, $100 a year, and you get tremendous coverage. I can't remember what I pay. I'd have to look it up. But I don't notice it because it's so inexpensive relative to my auto insurance. My auto insurance is the bulk of my bill. I don't really notice the condo and my umbrella. So the insurance pays the ultimate net loss in excess of whatever your deductible is, that limit. So the ultimate net loss is the amount actually paid or payable for settlement of a claim for which the insured is liable after deductibles, and then any recoveries from salvage. Salvage can be here the insurance company suing other people who might be contributory negligence. It may not include defense costs. So defense costs is interesting here. I won't get into this because I think to me it's a little bit messy to get into it. But you want the defense costs covered without a deductible, and then if you win, then your defense costs are covered. You want to look at these two things, because what you don't want to end up with is $50,000 of defense costs, which are not covered by your auto or home, and then this doesn't cover it because it's below the limit. So defense costs are a special case where and it's in the insurance industry's or the insurance company's interest to put those defense costs up there and make sure you use them so that they can reduce their ultimate loss. So it's an interesting, and we'll talk about the defense costs a little bit more when we talk about commercial liability, but not much. It's just something that you have out there to try to protect both the insured and the insurance company. So it gets back to this deductible. The maintenance of the underlying insurance is required, but it's only required to the standpoint that if you don't have it, you still have to cover that. So it's really not required that your umbrella is canceled if you don't have it. It's just that you're going to be paying $100,000 and $300,000 out of your pocket, and then the umbrella will be covered. There are some exclusions. Intentional injury is not covered, with a few exceptions. If it's self-defense, so assault and battery, if you intentionally harm someone, but it's to save life or property, that can be covered. Are acts committed to prevent or eliminate danger in motor vehicles. So you run into a famous old tree so that you don't hit a child, and you're sued for that. That can be covered. You can't be liable to yourself. So umbrella coverage is liability coverage. It is not property coverage. So it does cover property of others, but it cannot cover your own property. So you can't be liable to yourself. Business pursuits are always, and professional liability are always excluded. One thing here, be real careful here. I've always thought about this. Activities as directors and officers. If you're going to be a director or officer of an entity, you need to really stop and think, what could this entity do that would cause a loss? That they would look at your decisions as a member of that operating body, and that you could be sued. Now, I've been directors and officers of things where they provided the liability coverage for me, so I had coverage. And there are places like that. Like if you're a director or officer of a Fortune 500 company, they're going to provide you directors and officers insurance for several millions of dollars. I remember at UTSA, the insurance rep for UTSA would come in and talk to the directors and officers, and they were always very interested in how much coverage they have. It was usually like $25 million, which never seemed like enough for me. I was responsible for $7-8 billion worth of employee benefit plans, and I could be personally sued for decisions I was recommending for those plans, and $25 million just never seemed like enough to me. But you do get insurance, so that's good. But I know my condo has a managing board. It makes decisions, and I've thought about getting on that and help with decisions. My neighbor is the board chairman, and she does an incredibly good job, and we're very fortunate to have her. But there is personal liability risk that she can take in doing that. It used to be you could not be sued for your volunteer activities, but that's essentially gone away. And so when you get on these groups and you volunteer to do things and you're making decisions, so you're in that decision position, you really need to stop and think, what decisions could I make that could be considered negligent and I, as a member of this decision-making body, could be sued. And so I think it's unfortunate, but because of the environment that we are in, it almost makes more sense not to volunteer for these groups if you can avoid it, unless you just really have a passion for it. And then there's obligations for workers' comp. That's always excluded from insurance policies. It's hard to think on workers' comp how personal umbrella would really apply there, because you'd be working on a job. So it seems like that just automatically seems obvious that it wouldn't be covered. But anytime you have exclusions, and you have exclusions to the exclusions, there's probably some famous court case that brought this exclusion up. Maybe not always. Maybe some of these have always been just from the very first time they ever did one of these products. They just knew these were going to be excluded. And I'm sure there's been some important cases that have challenged some of these just to see exactly what does the policy say. So that's the homeowners policy. Where we're going to go next is we're going to cover a couple of special issues related to homeowners. We're going to start with mold, and I'm going to tie that to storm surge, and that's one of your challenges with the mold issues. How do you tie it to the storm surge issue? And we'll talk about both of them. We have some articles on mold that we'll cover, and I'll go through them. We'll go in detail through them. We'll talk about the Ballard's case. I'm going to show you a video I want to watch on that. And so we'll walk through exactly what I'm looking for the exam answer, and then we'll do the storm surge link. And then the second issue we'll cover on homeowners is catastrophe risk. And I'm going to show you some cool websites there. So what I want you to do on the mold issue is read the articles. There's 2 articles I want you to read. The first one's the longer one. Neither one is all that long. The second one's a fairly short article. But the first one gives you the history and background on it. So read those 2 articles. And then what I want you to do is to watch a video. It's an interesting video. So I want you to watch this video. It comes from Forensic Files. It's a TV show I like to watch. It's, I think, a fairly interesting program. It's usually about murders and figuring out the murderer through forensics. But this is an interesting case directly related to the mold case. So I mentioned the Ballards. You'll see in the articles the Ballard case. And the article, especially the first article, you're going to find it has a fairly, it tries to be balanced, but it may be slanted a little bit toward the insurance industry. Some of the insurance industry's discussions about debating whether mold really has any health issues. And I've always had the industry view because that's my bias. That's where I come from. So I want to give you the other side of this so you can see that there is another argument to this. The Ballard case itself, and I want you to watch it. It's about 22 minutes long. It's an interesting case. And we'll talk about this in the next class. But before we do the next class, I want you to watch that. I have 2 other things I want you to watch related to catastrophe risk. So because these videos together are about an hour, 40 minutes, I'm going to keep today's class short, and I'll cut a little bit out of the next class. So this class is about 40 minutes. The next class will be about 40 minutes because I want you to do an hour 40 with these videos. And so take notes, get some good background. These are really excellent videos. I have some students that don't like the earthquake risk one. I love the earthquake risk one because it really shows you how difficult earthquake risk is for the insurance industry, because it's really, really hard to measure and really put your hands around it, whereas hurricane risk has much more clear statistics and math behind it and science behind it. So these 3 videos, about an hour, 40 minutes. So I'll take that extra 40 minutes. I've been making my videos about an hour. I'll take that extra 40 minutes and take 20 out of this one and 20 out of the next one, so that we don't use more time than I normally want to. So we'll stop it there, read the articles, watch this video, and then watch these other 2 videos, and you'll be ready for the special issues in insurance.